Hello everybody and welcome back for the Day 2 panel session on macroeconomic risk and demographic change. My name's Fiona Blyth and I'm a member of the Sydney University node of CEPAR. I'm a CEPAR Chief Investigator and I'm substantively a Professor in the School of Public Health at Sydney University and an epidemiologist, so I'm one of the lesser tribes of CEPAR. So just before we get started and I hand over to Mike after introducing him, I'd like just to remind everybody this is a live streamed online session. So I would like to take this opportunity to warmly welcome all of you who are listening and watching online. So unfortunately for those of you who are online, you won't get an opportunity to ask questions, but just as a reminder to all presenters and to the audience that in the question session, please use the microphones so that the online participants can hear what's happening. So it's now my very great pleasure to introduce Mike Keane, who is chairing the session this afternoon. So Mike is a CEPAR Chief Investigator. He's an ARC Laureate Fellow and a Professor of Economics at the UNSW Business School. In the last parallel session that I was in this room, Rafa had this really wonderful expression, a titan in their field. And I think if you read Mike's biography, you will agree he is indeed a titan in his field. I will be coming back up at the end of this session with some important housekeeping announcements about the dinner. So I'll leave now and hand over to Mike. Thanks, everyone.
Thanks, Fiona. I don't know who told you that. I'm Michael Keane. I'm one of the CIs at CEPAR, and I'll be moderating this session. Our first speaker in the session is Ayhan Kose, who is the Deputy Chief Economist at the World Bank, and he leads the bank's work on global macro outlook, right? I should have mentioned at the start, this is the session on macro and demographic trends. Unfortunately, Ayhan cannot be here in person today. So we're going to, we have his presentation recorded on video. So let's hope we can get this video to work properly here.
Good day to you all from Washington, D.C. Thank you very much for inviting me to talk about demographics and potential growth. This presentation is based on a recently released book on long-term growth prospects. We frame the discussion of long-term growth around the conceptual framework of potential growth. As you know, potential growth is the maximum growth rate that an economy can sustain in the long term at full employment and full capacity without igniting inflation. Effectively, potential growth is an economy's speed limit. Together with the book, we have also prepared a database with country-level potential growth estimates from 2000 to 2021, which you can download from the book's website. Today, I'm going to show you some results based on this work and conducted by my colleagues Francis Ostronge and Kirsten Stein. So the study, Following Long-Term Growth Prospects, also examines the implications of demographic shifts for potential growth from the perspective of especially emerging market and developing economies. In this today's short intervention, I'm going to focus on two specific questions. One, how are demographic shifts affecting potential growth? And two, how can labor market policies help lift potential growth? Throughout the presentation, I'm going to use this acronym, EMDEs, that stand for Emerging Market and Developing Economies. Let me start with the first question. How are demographic shifts affecting potential growth? Here, you see on the left, working age population for the global economy, advanced economies, and emerging market developing economies. Working age population as a share of total population had already peaked quite some time ago in advanced economies at 67% and is expected to fall to 62% by 2030. In the emerging market developing economies and the global economy as a whole, this share kept rising until the 2010s, but is projected to remain flat for the remainder of the current decade at about 65%. The chart on the right disaggregates the share of working age population by emerging market developing economy regions. We have 6 regions here. Basically, their acronyms closely parallel the regions you can guess. EAP stands for East Asia Pacific, ECA stands for Europe Central Asia, LAC stands for Latin America Caribbean, MNA stands for Middle East North Africa, SAR is South Asia region, and SSA is Sub-Saharan Africa. For the Europe and Central Asia region and the East Asia Pacific region, ECA and EAP on the chart, the share has peaked in the late 2000s at around 70%. It has since then fallen sharply for these 2 regions. In Latin America and the Caribbean and the South Asia region, growth in the working age population as a share of the total population will come to a halt in the next decade at around 67%. Only Sub-Saharan Africa still has a very young population and high fertility rate, and thus the working age population as a share of total population is expected to keep rising from about 55% today to 57% by 2030. I'm going to go back to this discussion about regions in the second question. But before I do that, let me briefly talk about evolution of potential growth. As you see in this figure, over the past 2 decades, there has been a broad-based decline in potential growth that span advanced economies as well as emerging market and developing economies. Global potential growth, as you see on the left, as estimated using the production function approach, fell to 2.6% a year over the period 2011-21, down from 3.5% a year during 2000 to 2010. As you can see here, the decline in potential growth was felt in advanced economies during this period, as well as emerging market developing economies. Going forward, the 2020s will be even more challenging when it comes to generating growth. At current trends, potential growth will fall by another 0.4 percentage points globally to 2.2% per year in 2020 to 2030, and by another 1 percentage point in emerging market developing economies to 4% for the rest of this decade. In other words, potential growth will decline from 6% in the first decade of this century to the third decade of the century. Now, how does demographic affect evolution of potential growth? You see some basically results based on this production function approach. So approach is obviously quite mechanical here. On this slide, blue bars show our potential growth estimates with the change in potential growth separated into a demographic component shown in red and other trends, in particular the investment slowdown or productivity slowdown, shown in orange. On the left, you can see that for the world, the slowdown in potential growth from the 2000s to the 2010s is mostly due to other factors. But about 1/5 of the decline is due to the demographic trends of an aging population. Going into the future, however, globally the impact of demographics will not only increase slightly, but will also account for almost half of the slowdown in potential growth for the rest of this decade. For advanced economies, demographics will be the main reason why we expect a slowdown into the remainder of the decade from the 2010s in the context of potential growth. The picture is quite complex for emerging market developing economies, as you see on the right. For this group as a whole, potential growth was not a factor when you think about the slowdown from the 2000s to 2010s. Having said that, for the remainder of this decade, from 2020 to 2030, we expect demographic trends to lower potential growth in emerging market developing economies by about 2 percentage points on average per year. This impact will be quite visible in the case of China. When you exclude China, you have, of course, growth dividend associated with demographic change in emerging market developing economies. So let me turn to the second question. How can labor market policies help lift potential growth? So far, I portrayed a gloomy outlook when it comes to potential growth, as well as demographic developments. But there are some good news. Global potential growth can be boosted by as much as 0.4 percentage points if countries make an all-out push to increase labor force participation rates of two groups of the working age population that have particularly low participation rates. These groups are women and individuals age 50 and above. There are other policy options, of course, but these labor market reforms alone have the potential to revert to expected slowdown in global potential GDP growth. The policy is not universal in the sense that you cannot have a cookie cutter approach in the formulation of these policies. And it won't be easy. Each economy will need to repeat its best 10-year performance in raising female labor force participation rates and encourage individuals age 50 and older to join the labor force at rates that are comparable to the participation of the cohort that is 5 years younger. But it can be done, and it has been done before. So with that in mind, let me briefly talk about female labor force participation. We all know that the female labor force participation rates are much lower than male labor force participation rates. The blue bars in this chart show the average female labor force participation rate from 2011 to 21 for advanced economies, emerging developing economies, and the 6 EMD regions. In advanced economies, on average, labor force participation rate for men is around 66% and only 52% for women. In emerging developing economies, this gap is even wider, with 75% of men participating in the labor market compared to only 45% of women. The red diamonds here show the expected labor force participation rates of women for the next decade based on past trends. These rates are not expected to change much. In some regions, the participation rate of women is particularly low, such as in the Middle East and Northern Africa region, as you see here, and the axis is on the right for these two regions. In these two regions, for example, in Middle East, North Africa, female labor force participation is around 20%. In South Asia region, it is just around 28%. Having said all of these, many countries have been able to raise the female labor force participation rate in the past 2 decades. Therefore, as one of 2 policy scenarios, we have simulated the impact of an ambitious but achievable reform scenario in which each country repeats its best 10-year performance since 2000 in raising labor force participation rates, as shown in these orange ticker or orange lines in this figure. We undertook another simple policy experiment involving improving the labor force participation of individuals age 50 and above. Globally, 47% of individuals age 50 and above participate in the labor force, compared to almost 80% for the cohort age 30 to 45. After the age 45, labor force participation rates start to fall with age. The blue bars in this chart show the labor force participation rate for individuals age 50 and above for advanced economies, for emerging market developing economies, and EMD regions. These rates are particularly high, as you can see, in East Asia Pacific, excluding China, and Sub-Saharan Africa at around 60% and 65% respectively. On the other end of the range are the Middle East, North Africa, and Europe, Central Asia regions, with about 34% of individuals age 50 and above participating in the labor force. As with the female labor force participation rates I discussed before, these participation rates are not expected to change much in the decade ahead, shown here as the red diamonds. At the same time, large achievements have been made in health and life expectancy, and it is not unreasonable to believe that labor force participation rates of each 5-year cohort, starting at age 50, could, over the next 2 decades, reach a higher labor force participation rate of the preceding cohort. The resulting labor force participation rates in this scenario are shown as the orange bars. So what are the implications of these 2 policy experiments? I'm going to talk about that next. These 2 reform scenarios, raising the female and age 50 and above labor force participation rates, would be enough to reverse the expected slowdown in global potential growth in the decade ahead. The chart on the left shows you the impact of raising female labor force participation rates in yellow, and the impact of higher participation rates for cohorts age 50 and above in red. The combined impact would lift global growth, potential growth, by about 0.4 percentage points, enough to reverse the expected slowdown in potential growth between 2011-21 and 2020-30. For advanced economies, these reforms would have an even larger impact of 0.5 percentage point per year added to potential growth. The chart on the right shows the reform impact in emerging developing economies. Because the population in these economies is younger than in advanced economies, and labor force participation rates do not increase as much for older individuals, the impact of these reform scenarios would be almost equal, adding 0.25 percentage points to potential growth in the next decade in emerging market developing economies. This impact is not enough to reverse the expected slowdown in potential growth in all EMDs, and that will require, of course, 0.9 percentage points increase. With this, let me conclude. I focused on 2 questions and tried to provide brief answers. The first one, how are demographic shifts affecting potential growth? Our answer is accelerating demographic shifts are expected to contribute negatively to potential growth in almost all emerging developing economy regions in the decade ahead. The only region that's going to see a little bit of a support, in fact, is South Asia region, and that's because of India's the huge potential when it comes to demographic change. Second, how can labor market policies help lift potential growth? Here, we conducted these 2 experiments. These are simple mechanical experiments, but they are very powerful. An improvement in female labor force participation would raise potential growth similarly in emerging developing economies and advanced economies, while social benefit reforms will contribute to potential growth, particularly in advanced economies. I invite all of you to check our studies on the web. Let me thank you again for inviting me. I wish I could be there in person, and I'm hoping to do that in the near future, visiting my favorite country, Australia. Thank you. Have a wonderful discussion.
Speakers are both affiliated with the Center for Applied Macroanalysis, CAMA, at the ANU. And our first speaker is Adam Triggs, who's a visiting fellow at the Asian Bureau of Economic Research at CAMA, and he's also a partner at Mandala, which is an econometrics and AI consulting firm.
I think that's a really good segue. Ayhan has talked there about a lot of the big demographic shifts that we can expect and the impact that those are likely to have on potential growth. What I wanted to focus on is some of those sharper risks. So I want to focus on what do those demographic changes that Ayhan talked about, what do they mean for broader macroeconomic risks, and in particular, what do they mean for this challenge around global current account imbalances? So when we talk about the current account, we're talking here about the difference between savings and investment in different economies. So Australia, at least historically, has more investment opportunities than we have domestic savings, and we plug that gap by borrowing savings or importing savings from overseas. So we run a current account deficit normally. COVID has shifted that a bit. And then on the flip side, you have countries like Germany who have more savings than they have in investment opportunities, and so they export savings out to the rest of the world and hence have a current account surplus. The sort of hypothesis that I want to explore is given there at the top, which is aging populations could worsen global current account imbalances, feeding these broad macroeconomic risks, and this is particularly the case in developing countries. So that's the hypothesis that I want to unpack, and I'll unpack it in these sort of 5 steps. The first step is to look at these imbalances themselves and to show that these global current account imbalances are worsening. We can see that they worsened considerably in the lead up to the global financial crisis and then dropped off quite sharply, but since the pandemic have started lifting up again, heading back towards their pre-GFC level. The second thing I want to explore is what are the actual risks that potentially come from this. There are debates around the nature of these risks. The global financial crisis, Ben Bernanke and others have put these imbalances at the core of that crisis as being one of the key drivers of the crisis by fueling asset price bubbles and other shifts like that. There's a lot of political risks involved in this as well. Obviously, the Trump administration, the Obama administration, the Biden administration have seen these imbalances, usually through the prism of trade, as being a source of significant discontent. And for developing countries, there's the risk of a sudden stop. That if you are a substantial importer of savings, the risk is that you hit a point where markets turn on you and then you have the savings reverse direction quickly and cause a lot of instability for your exchange rate and your financial sector. So things like the taper tantrum in 2013 is an example of this. The third thing I want to look at is then what's the role of these demographic changes in potentially worsening these risks, in particular what Ayhan talked about, which is the risk of aging populations and what that might mean for these imbalances. I then want to talk a little bit about what are the policies that are being pursued to try and reduce these imbalances and whether or not these are the right policies. And then finally, thinking a bit more on that policy side about what we could potentially do to try and reduce these risks, given that we've got these changing demographic risks which might make these worse in the future. So the first thing to look at is these imbalances themselves. And what I've got here is just a comparison between 2008 and 2018. And I'll come to where we are today in the next slide. But this comparison, so I've got it here, it's in US dollars, so you can think of this as the export or the import of savings. It's in US dollars rather than as a percentage of each country's GDP, because what we're focusing on here is the role that these are playing in the overall global economy. And you see that in 2008, it's fundamentally a China-US story. So in the lead up to the global financial crisis, when the G20 was formed as a leaders forum, this was a huge topic on that agenda, partly because a lot of people like Ben Bernanke had said that this savings glut coming from China was one of the reasons that we saw these inflated asset price bubbles in the United States and then triggering the crisis itself. So the United States, fundamentally a story there of being the global numeraire, where the US dollar and US financial assets play a fundamental role in the financial system, meaning there's lots of money that flows into the US to purchase those assets and to purchase US dollars, which results in a substantial current account deficit, along with huge fiscal deficits in the US at the same time. And then China, which was characterized as being a story around precautionary savings, the sort of weak social safety net, which led a lot of people to save for their retirements and to save in case there was a materialization of health risks. Also, the role of state-owned enterprises in having above normal levels of savings, and also exchange rate issues, keeping the exchange rate competitively undervalued as fueling some of those savings as well. What's really striking, though, is when you shift from 2008 on the left over to 2018 on the right, the US stays as the main deficit country, but China has dropped off completely. And partly that's because as we got further into the 2010s, the savings rate in China started to drop. It went from about 50% down to about 40%. We saw more consumption in China as well. So the shift here went away from China and it went more towards Germany. And indeed, the political tensions in the US shifted their ire from focusing on China to focusing on Germany and what Germany and Northern European countries, including the Netherlands, could be doing to try and reduce these imbalances as well. And that brings us to today. So on the left, we can see after COVID-19, China is back. So China, again, being the leading driver on the surplus side of these global imbalances. And partly this is because of the huge demand during the pandemic for a lot of China's exports, and also an increase in savings in China as well. And a huge blowout in the United States, where the size of their deficit has gotten even bigger, and that's largely from the substantial fiscal stimulus over many years from President Biden's administration. But again, we've sort of shifted back to largely to where it was pre-global financial crisis. And if we look at the trends or the forecast, these are all from the IMF. The forecast is for China to reduce its current account surplus as its savings rate goes back down, and Germany to start picking up again and to return back to where we were pre-COVID in terms of the composition of those imbalances. And this is what the whole story looks like. So in terms of the global imbalance story, if we put it on a graph, the way that the IMF normally does this is to take the sum of the absolute values of all of the current account surpluses and deficits in the economy to see how big those imbalances are over time. And what we see is from the 1980s through to the global financial crisis, a substantial ramping up in the size of these imbalances. And then after the crisis, about a third of a reduction in the size of those imbalances, to then steadily continue declining until now we see it starting to pick up again after the pandemic. So we see an increase of about 42%. This is not only the pandemic, it's also the impact of the war in Ukraine. So we're seeing advanced economy deficits increasing during the pandemic as they increase their imports, and the war in Ukraine boosting surpluses of a lot of commodity exporters as well as being part of this story too. And when we look at the reduction after the global financial crisis in these imbalances, the IMF in its analysis in 2017 concluded that this wasn't really the result of policy interventions. It was the result of a compression of demand in advanced economies in the period after the global financial crisis. So it leads to the next question, which is, are these imbalances a problem or not? Now, there's a lot of economists who will say that if you have private decisions around investment and savings being made in each country, whether or not that leads to a surplus or a deficit and what that means globally is really just an exercise in accounting. It's not really something to be worried about. The argument that comes from people like Blanchard is that a lot of these imbalances are actually being driven by distortions. So in the surplus countries, distortions include things like a lack of adequate social insurance, which leads to that precautionary savings. It can be inefficient financial systems, which lack sufficient depth and leads to low investment as a consequence. And it can be things like an inadequate global financial safety net. Countries in East Asia would prefer to chew broken glass than go to the IMF for assistance after the Asian financial crisis, and so accumulate a lot of foreign exchange reserves to avoid that from happening. And then deficit economies, it's around issues like poorly regulated financial systems, and then fiscal authorities are ramping up their spending or cutting taxes, and then resulting in big deficits, part of which, or all of which, is then financed by borrowing internationally and bringing in more savings. So it can be the product of these distortions. The other argument, this is the Bernanke argument, which was made by Mervyn King and Maury Obstfeld and Rogoff and a number of others, is that role that the surplus of savings played in pushing down interest rates around the world, potentially fueling asset price bubbles, and then triggering things like the global financial crisis, along with arguments from developing countries. Dede Basri, the former finance minister of Indonesia, would always lament that if the current account deficit of Indonesia exceeds 3%, they get penalized by international financial markets. And that risk of a sudden stop tends to materialize whenever there's an increase in the US dollar or international volatility. So there is a concern in particular for developing countries as well as finally the political tensions around this. And this is the role that the US, for example, that their fiscal deficit plays in increasing the value of the US dollar, and then in turn leading to big trade deficits, which have been a cause for political concern among a number of administrations now. And then that brings in the role of demographic change. And Ayhan has talked about this, and Warwick will talk about this a bit more. In fact, this is stolen from one of Warwick's papers, which is just looking here at what impact these demographic changes might have on current account balances. And we see that a number of the economies that already have large surpluses tend to be increased. So countries like Europe, and then countries like the United States, you tend to see an increase in the size of their deficits. So there is a concern here that as you get an aging population, that it starts to inflame, in some countries, not all, but it starts to inflame these imbalances even more, and then requires more of a focus on what we can do to try and control these imbalances to the extent that they fuel these macroeconomic risks. Which brings us to what the G20 has done. In 2008, when Tim Geithner was the Secretary of Treasury, he suggested that every G20 country should have bans around its current accounts. You shouldn't be allowed to exceed 4% as a surplus or 4% as a deficit. His suggestion was politely rejected by the G20, probably because the US in particular would struggle to comply with that one. But nevertheless, it showed just how big this concern was, and it became a center point for the G20's agenda, is reducing these imbalances. And they pointed the finger at 3 countries and 3 issues. The first was the US and the size of its fiscal deficit, and said that the way to reduce these imbalances is for the US to put its fiscal policy on a more sustainable trajectory and to reduce the size of its deficit. The second was Germany, and the prescription here was that Germany needed to spend more money, but particularly it needed to invest more in infrastructure, was the main commitment that the G20 made there. And then the third was around China and the need for China to increase consumption, to reduce savings, and to boost the amount of consumption taking place in its economy. A paper that Warwick and I did a couple of years ago looked at these scenarios and whether or not they're effective. The first one we looked at was around the United States and reducing the fiscal deficit in the US. So here we're modeling a reduction in spending by about 5% and modeling it using the G-cube model. And what we found is that for the United States, so this is all relative to the baseline, you see an improvement in the US current account deficit. So that is the size of the deficit does shrink. And that's not surprising. The US government, by spending a lot of money, borrows that money from financial markets, pushes up interest rates, which draws in more capital, and thus results in a bigger current account deficit. And on the other side, when we look at China and Germany, the focus of the G20 commitments, you do see a reduction in both the Chinese surplus and the German surplus. So one of the key insights here is that if the United States wants to reduce the current account surpluses of Germany and reduce the current account surplus of China, it can actually act unilaterally, and it can do that by reducing the size of its deficit. So complaining to China and Germany is not necessarily required. They can actually fix this on their own if they were to take this action, with consequences and trade-offs in terms of what that reduction in spending does in the economy, depending on what it's focusing on. The second scenario is for Germany, and this is modeling the scenario of an increase in German spending on infrastructure. So you have a simultaneous increase in government spending, and then you have an increase in the productivity that comes from that increased investment. And the consequence we see here is a reduction in the size of Germany's current account surplus. But on the flip side, on the plus side, in terms of the objectives of the G20, you do see a reduction in the size of the US deficit, but you also see an increase in China's current account surplus. So that runs counter to the objective of the G20 there. And partly that's because, or primarily it's because, as Germany increases its spending, it's drawing in savings to finance that, and some of that comes from China, which means that their current account surplus gets bigger through that impact on relative interest rates. And it's also worth noting the size of this effect is fairly small as well. So although it does reduce Germany's surplus, it doesn't have a huge impact on the US or on China's for that matter. And then the final scenario is the boost in consumption in China, which has a substantial impact of reducing the size of China's current account surplus, and it reduces the US deficit, but it also, the converse of what the previous slide, it increases the size of Germany's deficit. As China pulls in savings, you tend to see this sort of seesaw effect between the two. So the overall impact of the G20's commitments here are a little bit mixed. And it's worth noting that the G20 hasn't managed to achieve its commitments here over the last few years, as evidenced by the fact these imbalances are growing again, but also that the policies that they committed to achieve these weren't actually implemented either. And there's a case for cooperation here, that when you combine these together, in most instances, you see better outcomes in reducing the imbalances. So this shows the impact on the current accounts for all three countries, whether they're acting together, whether they're acting alone, or one of the other countries is acting unilaterally. And in all instances, except for Germany, the impact on imbalances is improved if they act together. Which is in many ways not surprising given the supply-demand relationship between these countries on savings. Which finally, just to conclude, brings to the question of what could we be doing about this. The G20's agenda hasn't managed to achieve its objectives. Doing these commitments at the same time would work, but the evidence is that they're not doing the reforms that need to be undertaken. So what else could we be looking at here? And one of the things we can be looking at is around the global financial safety net. So this both helps remove the incentive of countries to reduce their precautionary savings through the accumulation of foreign exchange reserves, but it also helps address the risk of sudden stops as well. So countries like Indonesia, countries like the other Fragile Seven, have access to liquidity when they need it, and if there is the event of a sudden stop, they are able to ameliorate those effects faster. Otherwise, it's the reforms domestically within deficit economies, much of which is going to be about fiscal repair in the United States and properly regulating financial systems to avoid those asset price bubbles. And in surplus countries, it's the things that Blanchard talked about, which is improving social insurance and social safety nets, and then looking at those issues around the safety net as well. And domestically within developing countries, it's about continuing their reform processes of strengthening their supervisory frameworks, making sure that they're hedging risks, they're avoiding the original sin of accumulating large amounts of foreign-denominated debt. And then it's looking at how they can manage, to the extent it's needed, those capital flows as well. As if they need to do that, then making sure that there are frameworks around how that can be done in an effective way. I'll leave it there, though. Thank you very much.
Good. Thank you, Adam. Fascinating. So the next speaker is Warwick McKibbin. Warwick is the director of CAMA at ANU, and Warwick doesn't really need an introduction because he's the most prominent macroeconomist in Australia.
I don't seem to have a mouse. I have lost the mouse, or my finger's not working. If there's someone who could... Perfect. Okay, great. Thanks very much. Yeah, thanks, Mike. I was going to make a joke about rather than being... No, it doesn't matter, I haven't got time. Okay, so let me just talk about macro risk. I'm going to have to cut this a little short because we're running out of time. I should stress that this is part of the CEPAR-funded project that has been looking at global demographic change and what it means for the macroeconomy. Wei-Feng Larry Liu and I have done a number of papers, and I'll be drawing on two of them in this presentation. So what I want to touch on is what are the macro risks, and we've already heard from the previous two speakers a number of these risks. I want to just give any non-economist in the room the sort of economics 101 about why these things matter and how they work. And I'll talk about how we model scenarios and just give you some insights from one particular scenario. Again, none of this work is meant to be a forecasting exercise. It's building a complex system that lets you understand what the key issues are and what the key pressure points are and how to respond to what Ayhan has talked about and what Adam has talked about in terms of some of these risks. So for the global economy, demographic change at the national level has implications for economic growth, sustainability of pension systems, health systems, fiscal spending. This has both economic and geopolitical issues nationally. But actually what's really interesting from our point of view is that this demographic shift we have experienced and will be continuing to experience is very asymmetric across countries. So we have different demographic adjustments happening at different points in time and in different countries. These adjustments in demographics lead to movements in trade flows. They lead to movement in people. If you incorporate immigration, they lead to a reallocation of global capital across national borders. And these adjustments imply big changes in real exchange rates and big changes in real interest rates. This again has national as well as international geopolitical and economic implications. Maybe I'll try using this. Yeah, okay, so just in terms of what do we expect simply from economic adjustment to a demographic slowdown? Ayhan has already talked about this in terms of slowing population means slowing labour force growth. That means slowing economic growth. That means lower investment because you've got smaller return to capital from a given labour force. And it also would also mean a lower risk-free interest rate. And that implies, in the monetary literature, any of you macroeconomists in the room, that means that you expect R star, that is the equilibrium interest rate that central banks form their monetary framework around, will be falling over time. And that's a serious problem which I won't touch on today. What we see across countries then is when we change demographics differently and we start to move capital and labour around the world, you're going to get movements of people through migration. You're going to get movements, if people don't move, then you'll get capital moving to where the people are. You'll get changes in real exchange rates and you'll get changes in trade balances that Adam has talked about. So this is quite complex because we're modelling countries individually and we have to close the global system and everything has to add up. So every current account surplus in one part of the world has to imply a current account deficit somewhere else. So what we do is build these models, transparent models based on very clear assumptions, and then vary the assumptions to see what actually happens in this artificial world. Now, I won't talk about the model. It's a quite complex model, and it's a hybrid of a dynamic stochastic general equilibrium model that macro central bank people use and computable general equilibrium models. The model we've developed for the CEPAR project has a big focus on Asia. So these are the countries in the model. The reason we did this is because our grant was to focus on demographics in Asia and what it means for the Australian economy. So we have a lot of detail, but in talking about the results in the scenarios, I will be aggregating the results just to draw out the key points. Now, this graph is somewhat different to Ayhan's because this is looking at the projections of demographic shifts between now and the end of the century. And there are two key aspects of what's happening demographically. One is sharply declining fertility rates on the left-hand side and increases in life expectancy on the right-hand side. These two demographic issues have very different economic implications. But what's interesting here is the dispersion across countries. The trends are very similar, except you have, in particular, if you look at Africa, which is the yellow dotted line, you have a lot higher fertility rates. Even though they're falling from a much higher level. And that is a key way in which the world can stabilise economically some of the demographic disruptions. How does this translate? Well, population growth rates are on the left. This is quite a familiar, this is what Ayhan was talking about out to 2050, but it continues. And the interesting point is on the working age population on the right, the world's working age population continues to rise, even though these growth rates are falling. So by the time we get to the end of the century, we're getting a lot more people than we have today. So we're going to make some assumptions here, and most people in the room won't like any particularly one of them. Firstly, we're not going to let people move. We could let people flow across borders, but we're going to hold migration at the underlying projections. We're going to assume that the reallocation of labour, if there is a reallocation of labour, it actually gets embodied in goods. So if you hold the populations in place, you can actually still get workers moving across borders embodied in the physical products that people buy. Or you can have capital flowing to where the workers are. And so this is International Trade 101. That is, if you hold migration fixed, you can still get the adjustment through either allowing trade, allowing a shift in the global trading system, or allowing global capital to flow. We're also going to make a very strong assumption, and that is where we are today, we're going to be very optimistic and do a scenario where the institutions in the emerging and developing countries enable an optimal allocation of resources. Right? So we have this incredible capacity to have workers in Africa, but the capital is sitting in the US and Europe, and we're going to we want to see how big are these movements if in fact we can get the institutions to allocate resources in an efficient way. And so we also do an extension here, which Alexia talked about yesterday, actually, in terms of age earnings profiles, and the fact that young workers, middle-aged workers and older workers earn different amounts. And we assume that that reflects different productivity. And this is what the age earning cycle that we put into this modelling framework looks like. So when you're young, you have a unitary productivity. As you get older, you get more experience and your productivity rises, which means the age composition of the labour force really does matter. So a labour force of young workers and middle-aged workers have very different productivity than labour force of older workers. Now, I and some of my colleagues in CEPAR are on this side where we go to zero productivity. That's just the way it is. Now, the scenarios then, and again, we haven't got much time to go through this, but what we're going to do is we're going to do a world in which we're going to project productivity growth by sector, and economists in the room will understand that there's a Barrow catch-up model. It's an empirical model about how quickly countries grow. We're doing this at the sectoral level. And we're going to do two different scenarios. One is let's take the world's population structures as they were in 2015 and don't change them. So we're actually going to have no demographics from here on, from 2015. The second scenario is, now let's look at the actual demographics and let's put these age earnings profiles by annual cohort of worker in each country in the world into the model and look at the different effects of the changing population structures. So I'm going to show you the difference between these two scenarios. What is the impact of demographics relative to not having demographics? And again, there's 5 different regions. The countries look very similar. We've aggregated the regions together. I won't go into that detail right now, but let's see what the world looks like then. This chart shows you 3 different bars for each country. The blue bar is the 2015 base. That is if the world's demographic structure is frozen in time, and that's 2015. The 2050 results show you what happens if the world demographic structure is still frozen in time, but we go out to 2050. So this is all coming from productivity growth. The third, the green bar, is what if we put the demographics, the age earning profile in there? And we can see that the world looks quite different. By 2050, China is nowhere near as big as we would think it would be because of the age earnings profile adjustment. Africa is a lot bigger than we think. Latin America is bigger than we think, etc. So these modelling the demographics changes what the world looks like. What happens now if we compare the scenarios? And here again, these results are the difference between the 2 scenarios. So this says the investment in Africa is the brown line on the left. It'll be 50% higher than otherwise would be the case. And by the time we get to 2050, it'll be 100% higher. So what happens here is there's a big investment boom in Africa. Why? Because you have a lot of these workers coming into the labour force, and the potential growth aspects of that, the increase in the return to capital, is quite substantial. You can see the GDP effects are very, very substantial. So demographics will make Japan, the yellow line on the right, smaller, Europe smaller, the green line on the right, and Africa a lot bigger, and Middle East and Latin America bigger as well. So there's a big change in the world economy just in terms of economic power coming from demographics. You can look at the sectoral output here. I won't go into this detail, but what it does show you is that mining, which is the yellow line on the bottom in Australia, drops dramatically relative to what it would be. That's the China effect. So the demographic change in China changes our exports of mining into China, and that means there'll be structural adjustment within the Australian economy coming from global demographic change. And you can see the distribution across countries. We can see which countries are causing Australia's GDP to be higher, and that is which countries' shocks are causing Australia's GDP to be lower. The China effect and the advanced developing economies effect are quite substantial. But they all tend to net each other out. So on the right-hand side, with or without the world demographics, Australia's demographic future really determines the Australian economy's size. How does this show up in trade flows? Well, this picks up Adam's point. Capital will flow into countries such as Africa that have the high rate of return to capital. That'll cause real exchange rate appreciations, and that'll cause a trade deficit. And countries who are exporting capital into these fast, more quickly growing economies will run trade surpluses. And these are of the order of 5 to 15% of GDP. These are big numbers. These are much bigger than the numbers that we've seen historically that Adam has talked about. So what are the key insights? And I'll stop here. The projected demographic change just from this one scenario, which is the medium fertility scenario from the UN, could reshape the global economy between now and 2050. This has important geopolitical implications. The long-term transitions and the short-term shocks that we're seeing around us today are going to be very asymmetric across countries and across sectors. This means you're going to get different outcomes in investment, different outcomes in private and public savings. This will all show up into big shifts in international capital markets. This leads to movements in real interest rates and real exchange rates, and this leads to quite substantial movements in trade balances. If you hold immigration constant, then it will either be showing up through movements of goods or capital. Of course, if you let immigrants move around, that'll change the story quite substantially. And we'll stop there, and hopefully there's a bit of time for questions. Where do you want us to sit?
Okay, now we'll have questions from the audience. While we're trying to find a question, I have a question, not being a macro person. I was hoping maybe the macro guys here could explain The stuff Ayhan Kose was talking about at the beginning, about this slowdown in potential growth, could you say something about why that's important, or is it?
Well, so some people in the audience in particular would think that's a good idea, because if you're slowing down economic growth and if you're not pricing all the environmental damage and everything else that's going with that, that could actually make the world better off because you've got less economic activity. But the evidence is the more economic activity and the more you can pay for things that you want, and the more you can pay for policies that will improve the environmental outcomes. And so it's an open debate. My view is that you're better off having the resources to achieve the environmental quality that you want. But we're not feeding the environmental outcomes in this paper back into the economy, although we have done a lot of work on climate change and the implications of a worsening climate for economic activity and personal well-being. That's not in this particular study.
I was at a conference a couple of months ago, and there was a minister from India who was there, and someone posed that question and said, well, shouldn't we be trying to reduce growth so that we can sort of improve sustainability? And he said, sure, you go first, was his answer. And then sort of acknowledged the huge number of people below the poverty line in India and around the world for whom this isn't an option. So I think there's a sharp sort of political and inequality angle to a lot of what Ayhan went through in terms of those growth projections and what they mean for people as well.
But I guess what I'm more interested in is why does the overall growth matter rather than growth per capita? Because overall growth is largely slowing because the population growth is slowing. Why isn't it fine?
Well, it is it is GDP per capita that matters from a well-being point of view, but from a geopolitical point of view, it's the size of the economy. So you could have an economy with 1,000 people that have incredibly high incomes per capita, and you've got China with 1.4 billion people. Which of those is more politically powerful? And so that's the reason we do this, is to look at the geopolitical economic interface. But it's a fair point. You can also look at the per capita numbers.
Hi.
Okay.
Hello. I wanted to give Adam a chance to link your talk a bit more to aging. So what does that mean if we take into account aging a bit more?
In terms of aging, did you say?
Yeah, because it's a conference on, I guess, population aging, and it was in your talk, but I just wanted to give you a bit of, ask you a bit more, how does population aging impact the current accounts that you described and so on?
No, it's a really good question. The transmission mechanism there is that when you have an aging population, you get sort of increases, depending on where they are on that spectrum, you get increases in savings or changes from when you're young, you don't save much. When you're older, you start saving more, and then you sort of start running down those savings. So as you get those demographic shifts within countries, it changes that balance between your savings and investment within the country, which then changes whether or not you're exporting savings to the rest of the world or whether you're importing savings. And if we already have these imbalances where you've got these huge exporters of savings, these huge importers, and the demographics get in a particular way that they're going to start inflaming that, then all those macroeconomic risks that flow from that start to get inflamed as well. So that's the sort of link between an aging population and some of these risks.
Hi there. Hi. So I talked about different scenarios for labour force participation rates. Hi, just over here. So Warwick, a question for you. I note that you've got a profile by age which drops off to 0 in terms of kind of contribution production by 65. So have you looked at scenarios about what the changes would look like if you did sort of delay retirement participation rates and stuff like that for these countries?
We haven't done that, but we could do that. That's just an assumption that's built into the inputs into the model, so we could definitely change the assumptions. Again, when you're going out to 100 years to 2100, there are so many institutional changes that you might envisage that you don't want to be doing. You're not doing forecasts, you're doing different scenarios. You want to see how big these effects are. So you could change the retirement age to 70 and see what the impact would be in different parts of the world.
Yeah, do you have a sense of the magnitude?
No, I haven't. The bigger criteria the next step in this is what Peter McDonald has mentioned is we're using these age earnings profiles as an average across the advanced economies and applying them everywhere. The accounts that Peter and colleagues work on, you can actually get an age earnings profile that are relevant for the particular countries. And so you can actually do a much better job at quantifying it. It won't change the story, but it will change some of the relativities, particularly when you start getting into poorer developing countries and their age earnings profiles presumably look somewhat different. But the national transfer accounts have that data according to Peter, and I just haven't had a time for my team to work at on that extension.
I'd just like to follow up Mike's point about per capita income being an important thing. That's when I think of growth, I think of growth in per capita income. But that leads to productivity. Now, it seems to me that in your model, from what I can see, you had productivity profiles by age. And as a result, you have changes in the demography, more people heading towards 40 or away from 40. That's going to change the productivity level. So there would be, in your model, implications for per capita changes in welfare, per capita changes in GDP, I mean.
Yep.
There's two parts to the question. One, do you have any comments about that as to where those productivity improvements are happening? I presume in Africa, since they're the ones who have the high fertility. But the other question is, have you thought about alternative implications for productivity from aging in the population?
So there's two aspects of productivity in what we're doing here. We've got the economy-wide productivity catch up by sector. So the mining industry in Australia catches up to the US frontier, closing the gap, and the gap is the Groningen database productivity by sector where it's available. So there's a gap there, and then over time, if you did nothing else, we assume that gap will close at 2% a year in that sector. So each sector has its own particular productivity catch-up. The workers that are in that sector, when they enter that sector, they start with that productivity, and then their productivity will change at that age earnings profile over time. So it's quite complex. It depends what sector you're in, because each sector has different productivity, and it's growing at different rates. This is labour productivity we're talking about here. And so that's the first assumption. In terms of, yes, you're right, Alan, if you're young, if you're in Africa or India and you're moving into the middle age, you're going to get an acceleration of productivity per worker. But you also have got, on top of that, India has a much lower productivity in each sector relative to the frontier. So the sector itself will be growing much more quickly when the worker enters that sector. And so we try and keep track of that. Obviously, if we did per capita for the economy as a whole, that would be an interesting comparison to see if fast... Sorry, this is long COVID kicking in. Yeah, it would be interesting to see what that does in terms of per capita.
Warwick and Mark Kill. I'll ask you this question, but it also relates to the first speaker's presentation from the World Bank was talking about the need to improve participation rate, particularly among older people and women. Yep. And what occurred to me is, picking up on some of the other presentations of this conference, I'm wondering if that participation rate was just for paid participation or whether it incorporated the informal sector, the unpaid sector. Because that's quite important, and it's particularly important when you're getting shifts in demography with younger people needing longer education, raising older people living longer, needing more care. It shifts in demography that actually can put real pressure on that informal work. And if we're not counting it, we're overestimating the potential, and we're also probably not seeing some issues that we might. If you have any thoughts?
Yeah, so thanks, Mark. I mean, that's an important point. What we're doing here is we're assuming that participation rates are not endogenous in the model. We're taking the UN projections by country and by age cohort, and we're taking it as given, right? And so then when we do these economic shocks, it is possible. Now, we do get short-term unemployment in the model, so people can fall out of the labour force, and they can then come back in over time. So we do get that sort of dynamic, but we don't get differentials across gender because we have a single data set which doesn't distinguish between male and female participation. So there's a lot of things being held constant here. The more you break down those assumptions, the far more complex the outcome becomes. And so the idea of using models is not to explain the world as a whole, it's to understand bits and pieces and then put them together to see what's big, what's small, where should you invest more research time, what really matters. The first results from this says these numbers are potentially big, so we have to be prepared for these sort of adjustments and what does it actually mean in terms of other types of policies. So the answers here is not just we should deal with the demographic shock and try and offset the demographics. The answer might be, well, let's actually build a better world trading system so that these international trade flows can occur to minimise the disruptions. And so that's really why these models are useful. It's not to focus where the shock is, it's to focus on how can you actually deal with it from a economic and political, social well-being point of view. Not always the answers are in where the problem is. Well, just one footnote if I can. So when I was working for the Japanese Prime Minister Cabinet Office, they had two streams of research. One was on demographics and macro, and one was on climate change and sustainability. The climate change people were saying we want to have lower economic growth and therefore we want to stop babies being born. And the demography people wanted to subsidise childbirth to get a faster growing population. So these two groups of leading international experts came up with a completely opposite answer. And my view was I was in both streams and using these models, was, well, why don't you look at trade liberalisation, look at freeing up the labour supply in Japan instead of people sitting in elevators pressing buttons. Why don't you actually free them up and then you might have more nurses? And so the answers sometimes in these other issues can be found somewhere outside those issues, which is why you do the modelling.
So if I could mention that, as I think I remember this, that your model's projections for Africa are very optimistic.
Yes,
that the fundamental forces at work are going to drive up per capita income tremendously in Africa.
Yes.
But as you were just saying, that's conditional on what?
Well, you have to be able to absorb the capital. You need the institutional frameworks to be able to have that allocated, the capital when it comes in to be allocated where the returns are highest. You have to deal with the corruption, you have to deal with institutional failure. You have to deal with the fact that the reason these are developing countries is because they don't have the institutions to be developed economies. And so maybe the answer here is to invest in a whole range of institution building to enable the, and not because you want to do the right thing for Africa, but because by doing that you're going to improve the outcome for the rest of the world as well, because you can enable this reallocation of surplus labour in one place to deficit, to inadequate or insufficient labour in other places.
You see a similar risk in the climate change space where we talk about the huge sustainable investment that's required in a lot of developing countries, but the only way that investment's going to take place is if they allow that capital to come in the first place. If you change that assumption around whether or not they're willing to bring that capital in, if it creates financial risks or whatever, then it changes the sort of profile there as well.
Yeah. So that's an example of how what you're doing is not really a forecast. It's more of a lesson.
Well, it's just to understand a complex system. I don't think you can understand a complex system in 4 equations. I mean, that's what most of macro does. And that's why a lot of macroeconomists at central banks get it badly wrong, because the world is not just 4 equations. We have 35,000 equations in our economy, because the world is a lot of individual behaviour, which is complex.
Okay, any more? I guess there are no more questions. Ironically, after all this talk of deficits, we've created a time deficit for everyone.
Sorry to be the fun police, but I just wanted to thank all of the speakers and the chair for a really fascinating session. Just my head is so full of things I have to think about now. So please show your appreciation for a wonderful session.